Greetings from 3Edge Asset Management, and welcome to the 3Edge Week in Review for the week of November 16th. I'm Fritz Folts, Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. This week, along with a brief update on the global capital markets, Steve and I will discuss the idea that investing for the long-term success, to use a sports analogy, defense wins championships. But before we get to that, let's just take a quick look at the global capital markets this week. Bring Steve in here. So Steve, early this week, global stocks continued their rally. Both the Dow and the S&P reached all-time record highs on Monday. Investors were encouraged by yet another announcement from a pharmaceutical company about very positive results from phase 3 trials of another potential coronavirus vaccine. Then, as the week progressed, markets seemed to struggle a bit as new cases of the virus surged across many parts of the world, including the U.S., as the hospitals are once again seen to be pushed to the brink of capacity and states reintroducing or implementing varying degrees of lockdown. So investors are struggling how long the severe pandemic will last from here, while at the same time, the vaccine candidates seem to be advancing rather rapidly, and with the hope that we'll be able to return to a more normal life. So it seems to me that there's sort of this balancing act between the pressure from the resurgence of the virus versus the hope for the vaccine. Any additional thoughts on that?
As you said earlier this week, investors were focused on the good vaccine news, and you could say that they were looking across the valley, so to speak, to a better time when the vaccine would begin to be widely distributed. However, our latest IHME forecast is showing that this coronavirus will keep surging higher in the Northern Hemisphere, primarily in Europe and in the US, not as much in Asia, but will keep going higher until at least mid-January. So more bad news to come. And this could create a slowdown this winter, or at least stall the recovery that we've had since the spring. So this is an issue that we're watching closely. Also, an investment committee, we're also watching closely, keeping an eye on possible chaos that could come during the lame duck session, some rising geopolitical tensions between the U.S. and Iran, some rising geopolitical tensions between China and Taiwan. So there's a lot we're watching on behalf of our clients.
Excellent. All right, so let's get to our topic here. And as we know, 2020 has been a roller coaster of a year. We've experienced the dramatic declines in equities from mid-February through mid-March, followed by the equity market rally beginning at the end of March as the governments and central banks around the world came to the rescue. And now we have major U.S. equity markets hovering around their recent all-time record highs. So investors are struggling to understand what could come next. And the current environment reminded me of something that we have said in the past, and that gets to this idea that in investing, oftentimes defense wins championships. And you may ask, well, what does that mean? And how does it apply to investing? And at least my answer, before you get into it in greater detail, my answer would be as follows. And that is that, we often hear the refrain that when investors are investing, they need to hang in there. And you need to hang in there even when the market may be at near record highs as it is now. And you need to hang in there even during periods of market correction, as we had it from mid-February to mid-March when the S&P was down by over 33%. And then investors are shown these charts that show that, well, if you miss the best periods of market performance and you're out of the market because you got scared out of the market, well, then your investment performance isn't as good as if you stayed in there, which makes sense. The problem is, as we know, just hanging in there is much easier said than done. It's very difficult to do when equity markets are in a steep decline, or even now when equity markets are near all-time record highs as they are today. And importantly, at 3Edge, we think differently about this and when it comes to investing. And we believe that it's possible to play both offense and defense when managing portfolios. So I turn it over to you to give a more in-depth description of what we mean by investing defense can win championships.
Well, Fritz, I'm really glad you bring this up because it's always bothered me when I hear financial advisors or brokers telling their clients to always hang in there or always hold equities. Easier said than done. Like you mentioned, when the stock market is down 30, 40, 50%, human emotion takes over, and it is very hard to resist the emotion, the pressure that you feel, and not to bail at just the wrong time. So there is a better way, but data can really show that. Now, as you mentioned, studies get trotted out showing, look, if you miss the 10 best days, or if you missed, the few best months, look at all that you've left behind. So you should always stay in equities. And that always bothered me because it only showed half the story. And what we know, and frankly, you wrote an excellent paper called Defense Wins Championships, and you really studied this in great detail. And what you were able to show was that when you miss the 10 worst days, or when you miss, say, the 12 best months over many decades, then the benefits from missing those worst days far outweigh the costs of missing the best days. So I think we have a very powerful story to share for our clients, and it really tells the whole story, and it's grounded in good data. Now, I'd like to show this chart to our viewers. And what you're seeing is the performance of the U.S. stock market, the S&P 500 index, going back to the very beginning of 1972. So this is nearly 50 years of experience. Mm-hmm. And the blue line shows what would have happened if you just had $100 invested for the nearly 50 years in the S&P 500 index, and you never touched it. You just left it in. Well, of course, during the period, you would have had to suffer some amazingly steep drawdowns, and it would have been a lot of pain, but you stuck in there, and you would have made about 10.5% on your money before any fees and expenses. And your $100 would have turned into $13,000, which is the power of compounding interest. Mm-hmm. Well, if you did miss the 12 best months, then your $100 would have turned into $3,300, or 7.4%. So you might say, gee, you should have just always hung in there. But here's the other side of that. If you were able to miss the 12 worst months, then your $100 would have turned to $62,000, a 14% return, huge return. So then what you show in your paper, Fritz, is, well, what happens if you miss both the 12 best months and the 12 worst months? Well, you would have been a lot better off than if you just stayed in the S&P 500, and you would have suffered a lot less pain along the way. And in fact, your $100 would have ended up almost $16,000, which is 22% more than if you just stayed in the whole way and took all the pain along with it. So at 3Edge, we recognize this. We think it's a cop-out to say you just always need to stay in equities and always need to suffer every bear market. We think that by looking at the most important valuation factors and economic factors, behavioral factors, we can really help clients do a better job of avoiding the worst drawdowns and yet still making very good returns. So I thank you, Fritz, for highlighting this in your paper, and I think everyone can gain access to that.
Yeah, absolutely. It is. I didn't actually expect it to be as dramatic as it turned out when we finally crunched the numbers, but it is very, very compelling. So that will do it for us. As a programming note, Steve and I will not be doing our weekly 3Edge Week in Review next week because of the Thanksgiving holiday, but we'll be back the following week. So Steve, thank you again for your valuable insights today. Informative as always.
Well, thank you, Fritz. And on behalf of 3Edge, we want to wish clients and our friends who are listening very happy Thanksgiving and a safe Thanksgiving.
Perfect. We urge everyone to remain safe and healthy. Keep the faith. Together we'll get through this. And thanks for listening.